Welcome. In this video, can Zbcn coin rise 230% in a bullish wave? We will analyze this. Don't forget to subscribe and like, and please watch to the end to understand.
A descending trend on the price chart is a technical pattern indicating that sellers have been dominant in the market for a certain period, with the price forming lower highs each time it attempts to rise, following a downward trajectory. Such trends are typically represented on the chart by two parallel or slightly converging curves or straight lines. The upper one is the resistance line that the price encounters on every upwards attempt. The characteristic feature of a descending trend is that each time the price touches this upper line, it is pushed back down by selling pressure. This shows that buyers are not yet strong enough, while sellers take advantage of every rise to close positions or open new sell orders. However, in technical analysis, breaking such a descending trend often indicates that a significant psychological threshold in the market has been overcome. This is because the upper trend line acts like a fortress for sellers over a long period. Once the price breaks above it, the perception is that sellers have lost strength and buyers have taken control. If the break of the descending trend is supported by high volume, a much stronger upward move usually begins. At this point, sudden and sharp price movements known as a pump can occur. A pump happens when buyers enter the market aggressively after a trend breakout. This breakout not only attracts investors who follow technical analysis, but is also supported by automatic buy orders triggered when the price surpasses a long-standing barrier, the closing of short positions, short squeeze, and the entry of new investors driven by FOMO. In such a situation, the price can gain significant momentum in a short time. To understand the process of breaking a descending trend, it is first necessary to know how such a trend forms. Due to prolonged selling pressure in the market, negative news, a decline in investor confidence, or weakness in general market conditions, the price starts making lower highs with each upwards attempt. This downward movement also affects investor psychology. Seeing the price fall continuously makes investors hesitant to buy early, which makes the seller's job easier. But just as every trend has an end, descending trends eventually run out of steam. Weakening selling pressure, strong buying from support zones, or new waves of demand entering the market can pave the way for a breakout. The breakout moment is a critical turning point in technical analysis. Closing above the upper trend line usually indicates that the descending trend has ended and a new uptrend may begin. At this stage, a rapid upward price move is a sign that buyers have fully taken control. The acceleration of the price during a pump is often due to a reversal of the pressure created by the previous downtrend. Investors who have seen the price suppressed for a long time start buying quickly after the breakout. Since a significant technical resistance has been surpassed, a positive sentiment spreads through the market, triggering a chain reaction of buying. Another reason for a pump after breaking a descending trend is the presence of short positions in the market. During the downtrend, many investors open short positions expecting the price to drop further. However, when the price unexpectedly breaks the trend line, these investors are forced to close their positions to stop losses. Closing a short position means placing buy orders, which pushes the price higher. Especially when short positions are highly leveraged, even a small price movement can force them to close quickly, making the pump movement even more intense. Whether a pump after a descending trend breakout is sustainable depends on how the price behaves afterward. In a solid breakout, the price settles above the broken trend line and starts using it as a support. This is known as a retest in technical analysis. The price first breaks through the resistance line, then briefly pulls back to test this level and rises again from there. If strong buying follows the retest, it is likely for the price to move to higher levels and for the pump to continue. In addition, the news flow and the overall market condition after the breakout also determine the strength of the pump. If positive developments occur in the market at the time of the breakout, trading volume increases, and the overall market trend is upward, the pump will be faster and stronger. Conversely, if uncertainty dominates the market or the general trend is still downward, the pump may be limited. Therefore, when a descending trend is broken, investors should pay attention not only to technical signals, but also to the general market conditions. During the pump process that starts after a descending trend is broken, short-term targets are often determined using technical analysis tools. Fibonacci retracement levels, past horizontal resistance zones, and moving averages are frequently used for these targets. After the price reaches its first targets following the breakout, it may make small corrections, but if strong buying waves continue, higher targets may be tested. In conclusion, breaking a descending trend is considered a strong bullish signal in technical analysis, and the pump movement that starts at the moment of the breakout is often caused by aggressive buying in the market. The strength of this movement depends on whether the breakout is supported by volume, the closing of short positions, the FOMO effect, and positive general market conditions. Once the price surpasses this critical barrier, the seller's psychological advantage is broken and the market can enter a new upward cycle. With the start of the pump, the price can reach significant levels in a very short time. But its sustainability should be analyzed carefully and risk management should not be neglected.
The MACD indicator is a highly popular and effective tool used in technical analysis to understand the direction of a trend, the strength of momentum, and potential reversal points. It essentially measures the relationship between two moving averages to generate buy or sell signals. The first is known as the MACD line, and the second is the signal line. The interaction between these two lines provides important clues about the potential future movements of the price. In the scenario discussed here, a crossover has occurred on the MACD indicator, and after this crossover, the lines have continued to move upward, separating from each other. This indicates, from a technical perspective, the potential for the price to rise slowly but steadily. A MACD crossover is often a sign of the beginning of a trend change or the strengthening of an existing trend. Specifically, when the MACD line crosses above the signal line from below, it is interpreted by most traders as a buy signal. This movement shows that short-term price momentum has surpassed long-term momentum, indicating that buyers are gaining control in the market. When such a crossover occurs, the price chart often reflects upward movement as well. The important point here is that the lines continue to move upward together after the crossover. The steeper and more consistent the upward movement of the lines, the stronger the bullish pressure on the price. However, in this scenario, it is noted that the price is expected to rise gradually. This means the MACD lines are moving apart and staying in positive territory, but without a steep upward slope. In such a case, the price tends to show a more consistent step-by-step upward trend, rather than sudden and sharp spikes. These types of increases are often considered healthy because as the price advances with small corrections along the way, the trend is more likely to last longer. In contrast, rapid pump movements tend to lead to quick profit-taking and sharp pullbacks. Slow and steady rises, however, create an environment more suitable for long-term investors. The MACD moving upward in this manner also creates a positive sentiment in market psychology. Traders see the indicator remaining in positive territory after a crossover and the histogram growing as a strong sign for price direction. The histogram represents the difference between the MACD line and the signal line. An increasing positive difference indicates that bullish momentum is strengthening. Especially when histogram bars show higher values with each new period, it provides technical confirmation that the price is climbing slowly but surely. Another reason the price may rise slowly after a MACD crossover is that the market tends to enter positions cautiously. Especially after a period of sharp declines, investors often prefer to enter the market gradually when such crossovers occur rather than all at once. This gradual entry does not cause the price to spike suddenly. Instead, the price rises step by step, forming solid support levels along the way. This builds investor confidence and helps the trend last longer. A gradual rise in price following a MACD crossover is often a sign that the uptrend is still in its early stages. In the beginning, momentum is only starting to strengthen, buyers begin to enter the market, but the majority of participants have not yet fully joined in. This results in a more measured price movement. As time goes on, if the MACD lines maintain their upward direction and the histogram remains elevated, the trend can gain more strength and the pace of price increases can accelerate. It's also important to note whether the MACD lines have moved into positive territory. The positive zone, above the zero line, generally indicates that the market is in an uptrend. A crossover that occurs in the positive zone is an even stronger signal, as both short-term and long-term momentum are moving in a positive direction. If the crossover occurs below the zero line, it is more likely to indicate the early stages of a potential trend reversal, but not yet a fully confirmed uptrend. In a scenario where the price gradually increases after a MACD crossover, investors tend to hold their positions longer. A controlled, steady trend rather than rapid price movements creates a more comfortable investment environment psychologically. During this process, support and resistance levels are tested step by step, broken resistance levels turn into new supports, and the price continues to climb upward. Additionally, such slow and steady rises become more reliable when confirmed by other technical indicators. For example, if the RSI indicator is climbing from mid-levels,
The Elliott wave theory is one of the most comprehensive technical analysis methods used to understand market movements and assumes that prices move in waves within a certain structure. According to this theory, there are both impulse waves moving in the direction of the trend and corrective waves moving against the trend. There is a main movement consisting of 5 waves. The first, third, and fifth waves are impulse waves moving in the direction of the main trend, while the second and fourth waves are intermediate corrections. In the scenario we are discussing here, the price has completed its second wave, meaning it has finished a corrective process, and is now preparing to transition into the third wave. In Elliott wave theory, the third wave is generally the strongest and longest wave because at this stage, the majority of market participants have become convinced of the trend strength and take strong long positions. In this example, it is stated that the target for the third wave could reach the 3.272 level. This is likely a target determined using Fibonacci extension levels in technical analysis. Fibonacci ratios, when used together with Elliott wave theory, are particularly useful for predicting the potential length of the third wave. Most of the time, the third wave progresses about 1.618 times the length of the first wave. However, when the market is very strong, higher ratios such as 2.272 or even 2.618 can also be seen. The given 3.272 level is likely a technical level measured from the point where the second wave ended, marking the potential end of the third wave. Reaching this level is projected to represent an approximate 230% price increase, which is quite significant and could mean a major profit opportunity for investors. The third wave that follows the second wave generally appears with high trading volume. After the rise in the first wave, the correction in the second wave can create doubts about whether the trend has ended. However, when the price begins to rise strongly from the bottom of the second wave, investor confidence grows. At this point, both short-term traders and long-term investors start buying. Thus, the market enters an uptrend supported by a wide base of participants. The main reason why the third wave is long is this broad participation and strong psychological effect. The fact that the 3.272 level is given as a target is a very specific expectation in technical analysis. When the price reaches this level, it is generally thought that the third wave is nearing its end. However, it should be remembered that Elliott wave theory is flexible. Wavelengths do not always fit mathematical formulas. Still, historically, there have been many examples where third waves were strong and long-lasting. Therefore, after the second wave is completed, the probability of the price rising to the set target during the third wave is high. Another reason why the third wave is so strong is market psychology. During the correction in the second wave, many investors take profits or exit the market. However, when the price starts rising again, some of these investors buy back in to make up for the missed opportunity. This accelerates the rise. In addition, new investors who realize that the trend will continue after the second wave also enter the market. Alongside these two factors, technical traders see breakouts, trendline passes, and support resistance reversals as opportunities and take positions. When all this buying pressure comes together, the price climbs very quickly and strongly during the third wave. Having a specific target, like 3.272, helps investors plan their risk management more easily. On the journey to this target, intermediate resistance levels, Fibonacci levels, and psychological price points can be monitored. As the third wave approaches the target, it usually makes a few small corrective waves. However, these corrections do not break the strength of the main trend. On the contrary, they help the trend progress more healthily. Therefore, a projected rise of 230% indicates not just a sudden spike, but a price movement progressing steadily and supported by strong momentum. However, the most important point to note when entering the third wave is that prices experience their fastest and steepest rise in the middle of the wave. In Elliott wave theory, the third wave generally gains its highest momentum in its middle stages. Towards the end of the third wave, especially as it approaches technical targets like 3.272, some investors begin to take profits.
This can cause the price to move sideways or fluctuate slightly as it nears the target. However, if market expectations remain strong, the price can even rise above the target. Such situations often result in additional rallies carried into the fifth wave. A 230% increase represents both a great opportunity and something to be cautious about for investors, because high return potential also brings high risk. While the Elliott wave theory is a very powerful analysis tool when used correctly, it is important to remember that the market always contains unpredictable factors. Therefore, even in a third wave scenario, stop-loss levels should be set, intermediate resistance points should be monitored, and position management should be adjusted according to market conditions. In summary, the transition to the third wave after the second wave is one of the most critical and profitable periods in Elliott wave theory. Setting the 3.272 level as a target is based on a strong technical expectation supported by Fibonacci analysis. If this level is reached and the price increases by 230%, it would show the strength of the trend and how strongly market psychology has turned positive. Throughout the third wave, the market enters a strong bullish sentiment, both technically and psychologically, offering significant opportunities for investors.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.